Okay, good morning, everyone, and thank you for joining us. My name is Henk Heymans. As you can see on the screen there, I am a director at RSM South Africa. I'm actually in the auditing department. So we are going to talk to you today about the outlook for 2023. With me is Martin Ackerman. I will introduce him in a moment. Before we start, RSM South Africa, at RSM South Africa, we pride ourselves on being, on understanding your business. We believe in the power of being understood. And I have experienced it firsthand when we work with our clients, but more so when I am a client. I find that the people that are your service providers provide a much better service if they just simply try to understand what you are. What you're doing, try to understand your business. So that's what we're going to be doing today. We're going to look at 2023, but we're going to try to understand where we are and how we got here. Now, I'm not going to be entertaining you on economics. As I said, my forte is auditing. With me is Martin Ackerman, who will join me and he will discuss his outlook for 2023. And I'm also going to start asking him, if he doesn't mind, to go a few slides back and to tell us about how did we get here. So just some background on Martin. Martin is from Citadel. He's a chief economist and advisory partner at Citadel. He's got a master's in econometrics, an investment advice diploma. He's a member of the Chartered Institute for Securities and Investments in London. He's also an advisor to a number of Citadel's ultra-high net worth clients, member of the Chartered Institute of Secretaries, as I said. So he's definitely the right person to speak to us about it. He's also got some skin in the game because he manages the Citadel range of global objective matching portfolios. So Martin, welcome. Before I ask you my first question, welcome and thank you for joining us.
Thank you, Henk. It's a pleasure spending some time with you and your clients this morning. Looking forward to that.
Great. So as I said to the clients on the line, we're not going to tell you today about we have just been through a very tough time, 3 years of COVID, you know that. But what I found is that nothing has got just one answer. So how did we get here? The world is in turmoil. Is it only COVID? Is it only globalization or the different globalization that we have at the moment? Is it Trumpism? Is it the war in the Ukraine? What is the answer? On Twitter, we see always people try to find one answer and that is the definitive answer, but I don't think that's right. So Martin, if you can just take us a few steps back before we look forward, let's just look back and see how did we get here.
Yes, a pleasure, Henk. I think, the world over the last 4 decades or so basically went into a bit of a comfort zone. We didn't really have major challenges or crisis at hand. And typically, if you're in a comfort zone, you start to create bad behavior and you're not sharp enough, you're not thinking on the edge. And I think, especially over the last, call it 5 odd years, we started to understand that there are going to be changes and challenges. And yes, definitely COVID was one of those symptoms. And you can add to that also the war. Both those supply shocks, in a way, to the global economy made us realize that we need to concentrate a little bit more. And if you look at how markets reacted last year, 2022, especially dollar assets, they were nowhere to hide. And we had a very tough year in equity markets and probably more surprisingly in bond markets. In fact, the worst year since 1871. So it shows you that 2022 really stood out as a very difficult year for financial markets. But basically, to answer you and just show a couple of slides, where we went from that comfort zone to the challenges, there you can see that for a number of years, really, we haven't had any inflation in the world. This is US inflation, was on average around about 2%. And that already creates an environment where central banks and also companies start to get complacent and they don't think like inflation will ever be an issue again. And then suddenly, because of those 2 shocks that I spoke about, COVID, number 1, closing down factories and then struggling to get them open again. And then on top of that, the war in the Ukraine obviously caused this major increase in inflation. If you don't have an inflation problem for a number of years, the cost of money can also go down to levels we haven't seen in history, in some countries even below zero. And again, the cost of capital being almost nothing, again, create a lot of complacency and probably the wrong behavior. And with that inflation coming back, there you can see last year how quickly central banks started to tighten liquidity again to actually get inflation under control. We're not at the peak yet in terms of this normalization, but this was another symptom of basically 4 decades of complacency. And we were also fortunate that if we had a problem or a crisis during that time, central banks, or governments rather, actually bailed us out. So there you can see the huge increase in government debt, again, just showing the US, but it's the same for all of them, to actually help us during 2008, during COVID. And this time around, they can't do that because we sit with an inflation problem. If you print money in inverted commas in this environment, it will just put fuel on the fire. So this time around, they can't use this tool. And in fact, using this tool in a high interest rate environment creates another risk for central banks as well. Now, globalization wasn't just all bad. If you look at per capita income, the global per capita income since 1990, that was when China joined the World Trade Organization, actually increased quite a lot. You can see SA also benefited up to a point, and then we basically, under the Zuma years, started to move sideways. And unfortunately lost out on that potential to keep on increasing our per capita income. So when we talk about globalization, it's not all bad, but it certainly created a comfort zone that we need to be aware of right now and starting to adjust our thinking in terms of how we do business and how we actually invest money in that environment. So last year already, the economists started talking about globalization slowing down. This is basically as a result of countries looking at more diverse supply chain, not relying on a single country like China to get your goods from, and all the same like Europe, just relying on Russia for the energy. So it is basically saying, well, we need to look at more reliable sources. So here you can see that global trade is actually still doing okay. So even with globalization slowing, we don't see that it's falling off a cliff like we had in COVID or in 2008, but it is definitely slowing. So I think, this is how we got to this point, a little bit of complacency. And now, we need to face the music almost for the next decade. And I do think with the world changing some gear, there are going to be some challenges ahead.
I must say, it sounds interesting that you call it complacency, because I don't feel like I've been in a comfort zone for the last 40 years. It's been a challenge. So obviously, you talked about the global situation that got us here, and referred a little bit to South Africa. And let's just focus on the global again. I want to start with the global because obviously South Africa is part of the global process, and I want to get an idea of where is it going globally before we go to South Africa. So have we reached the bottom? Interesting, you mentioned the word globalization. It's a new term, and you showed the Economist headline as a cover page from not so long ago. So it is globalization. Is it coming or is it over? Where are we? Have we reached the bottom?
Yes, I think that process only started now. So we're probably going to see another decade of the world changing gear. The interesting thing is Trump actually started with the trade wars when he was president between the US and China. At the time, I think a lot of countries, didn't support that, but that was probably because of the personality than the actual, intention in terms of what they would like to achieve. Now, everybody around the world is adopting those policies where you look after your own security first. You make sure that you've got certainty in terms of supply, that it's not just about the cheapest, but it is about reliability. And while the world is changing, that's not an overnight switch that you can flick. It will take time. So we are going to face some headwinds. So what does that mean? If we look again at global economic growth, starting in 2000, that was really the most optimal years of globalization, if you like. Then for those 2 decades up to where we are right now, including 2 severe recessions, 2008 and then obviously COVID, the world basically grew at about 3.5% per annum. Now, that is very strong growth in terms of the capacity growth that the world is possible to turn out. But now we are, like I've said, facing some challenges. One of those are thinking about really diversifying your supply chain. We're already sitting with very high inflation, and central banks are addressing that with much higher interest rates. So the cost of capital is going up, which is a cost to business and consumers. And to be honest, inflation is coming down, but in a world where you think about alternative supply, inflation is going to be a structural issue. We're going to see above average inflation for the next decade, because if you're not buying at the cheapest source anymore, you actually embed some inflation going forward. So, for example, to open a factory in the US making chips instead of in China, in the last decade, we used China because it was cheaper. So that will actually embed a higher cost into the business and into the products. So what does that mean for growth? So the numbers that we look at, the world is going to take a step down. So for the next 3 odd years, growth is probably going to be 2%. So that's about 1.5% per annum lower compared to what we got used to over the last decade. And that 3-year period starting at the beginning of this year might even include a soft recession in the world, probably in the next 12 months. All the indicators at the moment are suggesting that the world is slowing quite rapidly. And, the US and Europe specifically is likely to experience recession probably at the turn of the year going into 2024. So that is a lower growth number. What does that actually mean in terms of company profitability? Well, if you look at this is what we call profit capture. So this is over the last 30 odd years. At the bottom, you see economic growth. And then depending on how fast the economy is growing, then typically what kind of earnings growth can companies generate in that environment. So if you take the last 2 decades, the global economy was growing at about 3.5%. That implied companies could grow earnings by about 10%. So that's quite healthy. That will eventually be reflected in equity markets or in share prices as well. So if we're now going to step down to an environment where the economy is only doing 2%, you can see that's huge impact on profitability. So the economy is going to face headwinds. And as a result of that, companies are going to be in a very tough environment where earnings are probably going to be sub 5%. It is real, so it is after inflation. So at least that is still positive. And as long as companies can do that, or those companies that can do that, that will remain a good investment because you will get a natural hedge against inflation. Get back to some examples later on. So there's inflation in the US. US already peaked in August last year. Europe, we haven't seen a peak yet. UK, definitely not yet. So this year, the peak inflation theme will play out. Most countries will peak throughout this year. And that will obviously pave the way for central banks to take it a little bit easier, which should provide some support to markets. But given this huge increase in inflation since COVID started, and like I already said, as a result of the war in Ukraine, central banks had no option but to normalize interest rates. And that sucked liquidity out of the system and was part of the reason why markets really struggled last year. This is a couple of scenarios where we might in middle of this year. We think that we're probably going to be around about 4% in the States in terms of inflation. It's not back to where they want it to be, around about 2.5%, but at least it's moving in the right direction. And again, that can create the room for central banks to take it a little bit easier. They won't start to cut interest rates yet, but at least they can start to reduce the speed that they are hiking interest rates. And that's what we saw yesterday with our own Reserve Bank as well. Talk about that a little bit later. Here you can see that all the important countries around the world last year hiked rates. So we've been in a hiking cycle after a decade of cheap money. It was only China and Russia that actually still supported the economies in terms of providing liquidity. But for most of the others, you're in a tightening cycle. So what does that mean? It means that for the next 3 to 5 years, the world economy is going to grow below capacity. Inflation will remain above central bank targets, and we're likely to see much higher inflation compared to the last decade. That is important because from planning point of view for your business or your personal portfolio, you need to make sure that you can beat that hurdle. Otherwise, in real terms, you're not going to move forward. It's a challenging environment for consumers and business, and there's definitely going to be slower profit growth. So that's the global backdrop at this point in time, Henk.
It's just such a tight balancing act. Now that you are saying it, the monetary authorities don't have much to play with, and same with the governments, and even employers and entrepreneurs don't have much to play with. It's so tight. But I get the feeling that the clients that are listening today might be feeling a little bit better after you looking at a global environment, because you are looking at positive growth, at least, and real positive growth, and saying that businesses, international businesses, can expect a positive growth. My question is going to be about South Africa, so we're going to get to that next. I just want to say to the listeners, we do have a chat function or a quick Q&A function. I'm keeping one eye on it, and just I'm having a look. If there are questions coming in, either we can deal with it as we go along, or we will have some time at the end. So please type your questions there. Then I think Martin will be more than happy to deal with it. So Martin, if we can move on to the local outlook. You said obviously the Reserve Bank made a move yesterday, and locally as well, we've got other concerns, politically, leadership, as well as, I suppose, we've got to mention load shedding as well. I'm sure you're going to. So let's take it to the local outlook.
Yeah, so if the global outlook or the global economy is facing headwinds, then obviously there's no way that we're going to escape that. We're part of the global economy. We're a very open economy, so we trade a lot with our trading partners. We are only 1% of the global economy, but that doesn't really matter. So if it's really tough out there, it is going to be tough on this side as well. And then on top of that, everything that you mentioned already, the structural issues are just going to impact us even further. So to put that into perspective, that's the same global graph that I've showed over the last 2 decades, where the global economy did about 3.5% growth. If we put SA on top of that, you can see that we actually track the cycle very close, but then we do get these periods of underperformance. So that was really state capture under the Zuma administration, where we had the last decade. So because of all of those shenanigans, we couldn't benefit from the strong growth in the rest of the world, and we started to slip, and that cost us a lot. And even after COVID, it seems like we're now more in sync with the rest of the world. So we should actually benefit from a strong global economy, unless we've got the wrong leadership in place. Now, because of that decade of underperformance, our number for the 2 decades came into 2.4% per annum. So that's a little bit more than 1% per annum over 25 years. So if you compound that, you can just do the calculation yourself. That's a huge loss in economic capacity. And that also speaks to a lot of the issues that we are dealing with right now, because if you don't invest or reinvest in infrastructure, then by the time that you realize that there are issues, it's too late. And that's part of what we're dealing with in Eskom at the moment. Now, if we look at SA for the next couple of years, also the next 3 years, unfortunately, we've got a more difficult global environment. And then on top of that, we've got the issues on the ground here that we need to sort out. So our number is 1.4%, and that's probably on the positive side. If you watched the MPC yesterday, you would have seen that they've reduced their growth assumption for this year to only 0.3% because of the current load shedding. So that's no growth, if you like. So we're actually in a recession. The population in SA is growing at about 1.6. If the population in the economy is growing faster than the economy itself, then we're not going to address unemployment. And we are going to remain a welfare state where we need to have things like social grants to avoid civil unrest and those kind of things. But I need to say that, when we look at that graph, that's for the next 3 years. And we'll talk about it a little bit later on. But there are things in the pipeline right now that if we continue doing that, especially now that President Ramaphosa got a second term, we will see some better results. But that's probably 5 years out. It's not going to be in the next 3 years. The important thing is that we just need to keep going at that. So what am I talking about? Things that you won't typically read about on the front page. So this morning is all about, the much lower growth expectation. On top of that, Eskom that's not getting out of the mess. We're sitting with high inflation. Fortunately, the central bank only hiked 25 bips, so they are taking into consideration that the economy is struggling. But if we look at something like fixed capital formation, as a percentage of GDP, it's been turning around for the last 4 quarters. We haven't seen 4 positive quarters in a row for the last 3 decades. So we need to take notice of what's happening here. So what is fixed capital formation? That is basically private and public companies taking money and reinvesting back into the economy, building factories, buying machinery, equipment, those kind of things. So the first thing on this graph, as you can see again, unfortunately, under the Zuma administration, there was just no trust, policy uncertainty, and companies just invested less and less and less up until this low bottom of only 12% of GDP. If you compare this number to other emerging markets, it should be around about 25%. So we were close there the decade before, but now there's a lot of room to make up from where we are currently. But like I've said, that's been turning. And this is the first step to get to a more sustainable economy and economic growth, because we need to rebuild capacity. We need to reinvest into things like infrastructure, rails, harbors, obviously electricity, to actually be able then to benefit from that down the line. So I'm just going to highlight a couple of things that is taking place as we speak. So there's a solar farm going up in the Northern Cape. This will be the biggest one in the Southern Hemisphere, creates about 2,000 jobs. This started even before the government scrapped a lot of the private electricity generation constraints. So that is a positive. While we're on this, the amount of solar panels that's been imported during the course of 2022, the expectation is that once all of those are implemented or on the grid, so to speak, that will add about 9,000 megawatts to the grid. So these things are definitely in the pipeline. The amount of non-Eskom electricity that's coming online is exponential, but we will only start to see that benefit probably outside of this 3-year framework. And Eskom is not going to solve this problem. It is going to be the private sector. There you can see another great example, Ford factory in Pretoria. They went off the grid also with solar panels. As a result of that their unit production cost dropped below that of Brazil, and the Brazilian plant's been closed and consolidated into the Pretoria factory, which is now the biggest factory for SUVs in the world, for Ford at least. So those kind of developments are taking place. We spoke about globalization. China is a great example where they used to buy all their clothes from China. During COVID, they basically missed a summer season because they couldn't get the clothes into the country. And beginning of last year, they decided that it's not just about the cheapest, but it is about reliability and having a supply chain. So they're busy building another factory in Cape Town. Will create 5,000 jobs, obviously good for the clothing industry again in this country. And after that, they will probably manufacture close to 60% of their range in SA. Back to the point that I've said, that is structurally inflationary, because now they're not importing from the cheapest source. So it is going to be some underpin to inflation, but it will benefit a lot of countries, companies and industries as we rethink our supply chain. Then, if you think about our farming, agriculture in this country is only 2% of GDP. It is quite small, but it is doing extremely well. Yes, unfortunately, right now we've got issues with load shedding. You probably saw about the chicken farmers, the farmers in Douglas, in the sense that they're next to the river, but they don't have enough electricity to do the irrigation. So there are some challenges, but despite that, we are still only one of 3 countries in Africa that's a net exporter of food, which means that there's a real issue in the world in terms of a nuclear war. We are a safe haven. We will be able to look after ourselves, and that's a huge benefit. We are a huge exporter currently of especially soft commodities to the rest of the world. So there's definitely some good news stories. If we pull that into the rand quickly, the rand's the black line here. The orange line is our current account. We can spend hours on this one, but very simply, when we print a surplus, there you can see that it's just inverted, so that's a surplus. So when we actually export more than what we import, we earn hard currency. When you earn hard currency, the rand can actually strengthen like we saw during that phase. That was just after the first downgrade as we went into COVID, and the rand went all the way from north of 18 to 13.25. Difficult economic environment, but we've earned hard currency. Then we started to open up the economy. This started to reverse. So we started to import more, especially oil, and especially right now, a lot of oil or diesel to keep the turbines going. We're back into a deficit, and then we earn less hard currency. So the rand started to slip. So that's the one reason for the rand. The other reason, obviously, is what's happening to the dollar. Here we had an extreme strong dollar because of interest rates going up in the States. That peak dollar is starting to play out. And that is the reason why the rand more recently got stronger, because of the dollar running out of steam. Where we are standing right now, we are facing the risk of grey listing still in the next month or so. So that's rand negative. If that happens, the rand can very easily go to 19 to 20 to the dollar. But if that is not a major risk, or the market starts to price that in, our view for this year is the rand is probably going to average around about 1650 to 1750. And if you really want to buy dollars, anything below 17 will be a good opportunity to do that. So that's the outlook for SA. Very challenging in a tough global economic environment. Definitely more social and structural challenges. And that's why there's need to be a balancing act between populist and business-friendly policies. We'll hear more about that in next month's budget. We need to look after things like social care until we get the economy going. And then there's some reform, although it's slow, but there are reforms taking place. So that's a view on SAing.
Okay, so there are some green shoots, and maybe it's time to, it's not time to run away yet. I'm going to ask you now what you think of that. I've got some questions coming in here. Maybe I should ask the first question now. You mentioned that Cyril Ramaphosa may act more positively now with the second term. Do you think that the ANC will support this? And how do you think this will affect support for the ANC?
Yes, I think the biggest risk we had before December was, not losing Cyril, but the power shifting towards the other faction. So if we see any sign that the power is shifting towards a radical economic transformation, that's a dead end road for SA. We can't afford that, especially not at this point in time. So the fact that the more business-friendly faction stayed in power, that means that they should have more commitment now to actually continue with some of the work that they've put into place. I think the president should be more comfortable now that, after all the things that's been happening and all the potentials to actually remove him from his office, now that he's got the mandate, he could probably start to act more aggressively. It's not going to change his way of doing things. He is a slow strategic thinker, but at least we are moving in the right direction. And then on the other side of the coin, we're in an environment where they can't afford any longer to try and have things like, let's say, a state-owned electricity generating company. So they are moving into that space where they're just opening up more towards private sector to resolve a lot of the issues. And by doing that, they're also aware of the fact that come the next election, if things continue this way, they're definitely going to have a below 50. So to avoid that last attempt, I do think we are going to see a speed up in reforms. So let's keep an eye on that. There's already signs of that that can happen, and that is exactly what we need at this point in time.
And if it does happen, let's say they do move forward, albeit slowly, as you just said, how do you think that will affect the support for the ANC? Do you think that below 50% might swing to above 50%? I know it's a very difficult question to put you on the spot now.
No, so we're obviously not political analysts, but the inputs that we do get from our third-party team in terms of that is that if it continues as it is at this point in time, then definitely a sub 50 in the next elections. And then it's a coalition kind of environment. And we know that we're not good with those kind of politics. And come what's a 2028, then probably that will be the point where there might be a very strong opposition that can challenge the ANC. But I do think, time is running out. What we've got 2 odd years. But if we see a serious change in implementation, but not only that, we're starting to see some results in terms of addressing some of these things that's keeping us back, then I think at least the ANC will be able to maintain some of their votes.
If you look at the disaster of coalition politics this week in Johannesburg specifically, I think we are in for headwinds, as you call it.
Yeah.
So some of your colleagues, and particularly one very outspoken commentator, I don't know if he's a political or economist, says that this is just a short-term strength, rand strength based on dollar strength. It's all short-term, so we must all take our money and run. Now is the time to get out of South Africa. So your next slide is investment opportunities. You're going to tell us to take our money and run.
Yeah, so maybe just a question to the audience. So last year, like I've said, was a very tough year. We were down 22% in dollars on the S&P. We were down, I think it was about 18% on US bonds. Even gold was down about 4%. Nowhere to hide. Any guess which market in dollar terms turned out to be the best performing market?
Okay, type it in your chat. I will watch. Okay, Martin,
it is a JSE. So,
JSE.
No one last year would have thought that at the end of 2022, if you look at all the different equity markets, the JSE will be the top performing market in dollars compared to the rest, especially if you look at the local economic environment. And that, again, just shows you that how asset classes behave. There's not always a direct in terms of what's happening in the economies on the ground. So you need to look at, obviously last year was a very specific commodity cycle and commodity companies that supported the JSE. But don't always turn a blind eye or turn your head away from economic challenges and think there's no opportunity. So on that, if we look at, for example, government bonds, our government bonds at the moment are yielding somewhere between 11 and 12%. I think that's about the second highest in the world if you adjust for inflation. So our inflation is 6 and a bit. So you're walking away with a very, very handsome real return. Yes, that is taxable if it's in your personal name. But if you put something like that into a pension product where you don't pay tax on the yield, in a world like this where you get a guaranteed real yield, that's an amazing opportunity. So for most of our clients, we've got a fair chunk of this currently in what we call our prudent portfolio. So that's what we call a shock absorber. To protect against long term. And yes, there are definitely fiscal risk. If the government is running into fiscal trouble, if we do see the grey listing, these yields can move higher. But I do think given the tailwind we had from commodities over the last couple of years, 2 years, that fiscal risk is starting to reduce slightly. So that's a great opportunity, even in this environment. US, as an example of global bonds, there you can see the pain with rates normalizing last year on the back of central bank action to address inflation. 4% is now much more attractive compared to a couple of years ago. It's not a dripping roast, but 4% in dollars, especially in an environment where the economy is slowing, those yields can go a little bit lower. You can make a capital gain on that as well. So suddenly your typical fixed income assets that historically has been a safe haven, after that repricing can definitely have a place back into a portfolio. If we think about equity markets, that's global markets since COVID. There you can see March decline when we went into lockdown. That was a 30% drop in a month. This is a roller coaster we had last year, and then this relief rally that we're in at the moment, which we are concerned about, because if we look at the economic fundamentals that I've just explained, we're still in for a challenging environment. Central banks haven't stopped hiking rates. Inflation haven't peaked in all countries. So we are definitely in a cautious positioning at this point in time. But that is the 20% that I referred to for the calendar year in global markets. markets. So to put that very long term, so there's your 22% in dollars on the S&P 500 for last year. This graph goes from 1920, and you can see that last year was a difficult year compared to history. And in fact, we even haven't had a recession. We had a slowdown in economic activity, we had high inflation, and we had a very regionalized war. And look at how markets reacted. The question now is, are we in for another difficult year? Well, economically speaking, yes, there's some serious challenges like I've explained. But if you look at the three circles, that's where we had another massive decline for another year or two before the rebound came. We're in a very different environment now compared to those three circles. That was a depression. We're not close to depression. We might see a soft recession, but consumers are in a much better position now compared to where they've been in the 1930s, especially the US consumer. They've paid back a lot of debt, so they've got some room to maneuver. That was the hyperinflation in the 70s. We're not in that environment. We had a supply shock that is working out of the system. There's no embargo on oil like we had in the 70s that will keep inflation high, so that's unlikely. And this was a NASDAQ bubble where we basically started with very expensive markets, where people paid ridiculous valuations for companies that didn't make a cent of profit. And that bubble took about 3 years to deflate. Right now, if you think about tech companies, they are making proper money, and markets are actually not expensive. They're probably fair value or even below fair value. So that implies that, yes, we're probably in for another bumpy ride this year. But that rebound after a very difficult period is becoming more likely. So like I've already mentioned, we cautiously positioned, but we don't just want to sell all equity because we are moving into a space now, and you never can time the bottom of the market, but we're moving into a space where a rebound is going to be possible in the next, 12 to 18 months, and you want to benefit from that. This is just the dollar. Henk, you spoke about that. The dollar's been very strong on the back of high interest rates. So when interest rates go up, people, investors like to keep dollars in their portfolio because now you get compensated for that by having a much higher interest rate. When this elastic band gets stretched, typically it causes something to break and there is a crisis. You can see each and every time historically we had a crisis. And the reason for that is a strong dollar suck liquidity out of the system, and then liquidity dries up. It's like running an engine without oil. Then it starts to seize up. Have we seen that crisis? I think you would probably argue yes, we have. Last year we had the Ukraine war, the cost of living crisis, which is still ongoing as we speak. This is just a bit of tongue in cheek, but UK with all their shenanigans that started to look like an emerging market. We've been through a tough time last year, so we probably passed the crisis event, and therefore, like I've already said, the dollar is going to run out of steam, and that will be rand positive. Then just on equities right now, we are facing headwinds, like I've explained. We are facing an environment where we're probably going to see less profitability, but still positive profit. But do you keep your equity now? Do you buy equity? Well, here's the answer. If you look at your PE, the price you pay for those equities, we look back into history and we just divide it into high, average, and then low. And then what you see here is the subsequent 5-year return. Now, the good news is that most global markets, US, UK, Europe, are currently on PE ratios in this bucket. So that implies that on average, if you keep those, or even if you invest in the market right now, and it's money that you don't need for the next 5 years, you can keep it in the market, then you're probably going to make a 5% real return over and above inflation in dollar terms. So equity is still, despite the economic challenges, a good investment. Back to my earlier example, if you're in an environment where you need to beat inflation, this is the only way you're going to do it. Cash is not going to do it, because cash, we know, after cost and tax, you're basically below inflation over time. You need to have companies to work on your behalf. Great example is Visa. As an example, they charge a percentage of transaction value. So if you pay 30 Rand for your cappuccino today with your Visa card, they take a percentage of that. If that price go up to 40 Rand tomorrow, they don't need to do anything. They immediately bank the inflation increase, and that is in their bottom line. So that's kind of companies that we are looking for. Don't want to spend too much time on this, but this is just a different asset classes at the moment and where we saw opportunity. I think I've mentioned that SA bonds and cash are starting to look quite attractive. SA equities are looking reasonable as well, in line with emerging markets. We think most emerging markets can do fairly well this year. Remember, China is getting out of their COVID lockdown. They've got pent-up demand. They're stimulating the economy. So as the rest of the world is slowing, China is probably going to pick up speed. We like gold because the dollar is going to run out of steam, and we're still in an inflation environment. So that's the asset classes that you need to be overweight. And for the rest is having a well-diversified portfolio. I think that's there's certainly still opportunities left in markets, and it's just to go and look for them.
It's interesting you mentioned that it's not going to be government that's going to make it, it's going to be private sector. And also, if we want investment, you need to look at companies. You don't, and it's the JSE, at investments in companies. And those people are the people that we're talking to today. That's our clients that are on the line. As you told the success stories or the exciting stories about Foschini and Ford, I can tell you there are many stories out there in the people that are listening online, maybe just on a smaller basis, but it's definitely happening, and we can see the positive success stories. We've got a bit of time left, and we will still have some question time as well. So if you can just quickly turn to your own family wealth, just a few quick notes on, take it to a personal level. We've now looked at global and then South Africa. Let's look at personal.
Yeah, so let's run through this quickly because I want to allow some time for questions, but this is just how we think about managing the client's wealth. So we're all in this, somewhere in this life cycle at the moment, which is divided into 3 phases, and each of those again into 3 phases. I assume most of us on this call is still in the earning phase, somewhere in the middle. We're not at retirement yet. The thing is that during that phase, you earn an income that will stop at some point, but your expenses obviously will continue. And you need to do some planning. Again, this is for your business or for yourself personally to say, well, I need to have a safety net that if I stop working or something happens to the business, I can maintain my lifestyle. The rule of thumb is that if you want to stop work at 65, which I think these days less people are doing, but nevertheless, you need about 20 times capital to maintain your lifestyle. So if you want R1 million per year, you need to have assets of about 20 million. And then you can have certainty that you're not going to run out of money. That's that number. So in terms of your personal economy, we all today are sitting in our business block. That is where you create your wealth. You're the specialist. You spend a lot of time and energy. We're not really going to give you an advice in terms of what to do there. The success there is then determining your lifestyle, what we call your lifestyle assets, whatever that might be, your passion. It is obviously your house and your car, but it's also things like maybe you like art or classic cars or whatever the case might be. That should be a function of the success in the business, not the other way around, and certainly not by using debt. And then the second 2 blocks is really where we start to add value. It is to say, well, you need to put away a core asset base that can support that lifestyle if the business ends or you get to retirement or whatever the case might be. So what is that number that we can calculate for each and every client? And that is in wealth preservation. Don't lose capital, keep up with inflation. And if you've got all 3 of those and there's still money left on the table, that is next generation. It's for the kids and the grandchildren, that surplus money. There we will also give advice, but that is all about more estate planning before you actually get to making any investment decisions. So my last slide is just how we think about putting a portfolio together. Is that if you do need money from the portfolio, so that's typically when you get closer to retirement, that 2 years of money that you need will be in cash, so that you don't need to worry about what's happening in markets. The money that you need for the next 4 to 6 years, there we will take some volatility. We want to beat inflation, and that is a shock absorber. And this is why, again, back to my point about equities. Equity should be long-term money. So that is money that you really don't need for the next 10 years. And therefore, you shouldn't be worried about having that in the market at this point in time, because you've got time on your side. It is volatile, but we know over 8 to 10 years, you're going to beat inflation. So if you construct your portfolio this way, then you can go through any cycle without a permanent loss of capital. To put it quite simple, if you only had an equity portfolio, 2022 came around and the market dropped 20% and you had to pay for your daughter's wedding, you're doing that at a loss, because you're selling at a loss, you will never recoup it. If you planned for that wedding and that money was already in cash, you can sleep well because you can pay that while you wait for your equity to rebound or recover. The middle one is your eat well one, where you keep up with inflation, and then the long-term money is really the live well, where you can actually make a little bit more as a result of that. So I'm just going to end with maybe just a final quote and then open for questions. Nothing too good or too bad stay that way forever, because great times plant the seed of their own destruction. That's where we started, the complacency that we've been in for the last 4 decades, through complacency and leverage. And bad times plant the seed of their own turnaround through opportunity and panic-driven problem solving. And that's where you are now. If you think back to COVID, panic-driven problem solving, how quickly the world found a vaccine. And you can add ESCOM to that as we speak. We're not going to sit here in the dark for the next decade. We are going to do something about it, but it will take time. And if government can't do it, we know that the private sector will do it. So we're just going through this panic-driven problem-solving phase, which always present a lot of opportunities. So I'm going to end there, and then we can take some questions.
Okay, I was getting a bit concerned when you started with seeds of destruction, but it seems like we are going to end positively. We are officially out of time. We should have finished at 9:15. So if anyone wants to or has to leave now, you are welcome. And I want to thank you for joining us. I also want to thank you specifically the people on the line for being those entrepreneurs or those business people or those professionals that are driving this. We can see all of these. We work on these with these difference makers every day in our business, and it's encouraging to see that these people are there and they are working hard, making things work and growing the economy for all of our benefits. So well done to all of you that are on the line. Well done for doing that. Well done for staying it out, and thank you very much for joining us. Martin and I will be on the line, so we do have time for a few questions if there are any questions. I've got one question, and I think, Martin, you've sort of answered it already, but maybe if you can just expand on it. You mentioned this rally that we are in at the moment. If you look at the last, about 2-3 weeks, the stock market has been hitting records almost every day now. And you call it a relief rally. What do you mean by that? Do you think we have reached the top of that? You said you're cautiously optimistic. Just expand on that a bit.
Yeah, I think, we expected maybe a 10% in markets this year. We already got it in January. So given the outlook for the global economy, that's a challenging environment where a lot of the interest rate hikes that we saw last year is only going to hit consumers this year. The Fed is talking about unemployment going up maybe in the second half of this year. So all of those are suggesting that company earnings are probably going to be under more pressure. We haven't seen a huge decline in earnings yet. So then a rally like this, is going to run out of legs very, very soon. A relief rally, because I think after Davos, there was suddenly some positive sentiment. The one we agree with, that is that China is opening up. They're stimulating the economy. So they late cycle, like what we saw after COVID in the US, where you had all the consumers going back to the shops with money because they saved a lot. And then you get that pent-up demand boom. That is going to happen in China this year. It's going to be positive for emerging markets, also for us in a way, because we're a commodity exporter. The other two is they talk about the infrastructure, green infrastructure spending in states. That is positive, but it's not going to happen this year. It's not going to happen in the next 4 quarters. And on top of that, the diversifying of the energy mix in Europe and getting off the Russian gas supply, that is also positive, but that is not going to happen this year. So I think the market reacted quite positively on those. But that's things that's in the pipeline, and we only will see the real benefit of that a couple of years down the line.
Okay, maybe this is the question that I wanted to ask earlier. Looking at the next 5 years, would you suggest that someone living in South Africa increase their local rand equity investment allocation and reduce the foreign global equity allocation, say 50-50?
Yeah, so I always say that if you're sitting on a yacht somewhere in the Mediterranean and you need to invest your money, will you put money into a small country that's only 1% of the world? Probably not. So we do have a lot of money here because that's where we create our wealth. But I think when you start thinking about preserving your wealth, you should diversify. There's so many, and it's not a negative view on the country, it's just simply saying there's so many other sectors, industries, opportunities in the rest of the world that you need to tap into. The JSE is a very concentrated market with very specific industries. And in a year like last year, where commodities are doing well, we will see the benefit. But from diversification, I'm still in favor of having more overseas than locally. And the rand, we are an emerging market, so the rand will always act as a tailwind in terms of giving you that additional benefit if you have dollar assets. So yeah, I would probably not bring more money back into the country. You need rands to live. A lot of that can be in the yield plays like I showed, where government bonds and cash are quite attractive. But you need to think about SA also as part of your emerging market mix. We are fairly positive on EM on the back of the Chinese opening up. So don't write off SA. But I would maintain diversifying probably with an offshore exposure, overweight offshore than onshore.
Okay, great. Thanks. I think that is our time for this morning. Thank you very much. Thanks, Martin. It was really, very insightful. I think to the people out there, maybe if I can finish where I started off, and that is that no question has just got one simple answer. It's a very complex environment we live in, complex as well as complicated, with lots of different questions, lots of answers, and interplay between all of them. You need help. You need someone who understands you. And yeah, I would definitely recommend talk to someone like Martin or at RSM, where we do believe in the power of being understood. Thank you very much, and thank you for joining us, everyone. Have a good day and a good weekend. Bye-bye.